Welcome. Thank you so much for joining me. My name is Holly Brostek. I am the owner of WIA Consultants, and we are in partnership with Creative Plan Designs. So for today, I put together a brief presentation with regard to something that's still available under the CARES Act until December 30th of 2020, and it's called the coronavirus-related distributions. Not to be confused with the enhanced loan provisions, which we'll go over briefly the differences of these in the next few slides. So a summary of what we're going to go through today is the first topic is we're going to look at what is a CRD versus what is an enhanced participant loan or loan relief under the CARES Act. Topic 2, we're going to go through what a CRD is, who's eligible for it, how much you can take, when you put it back, when it's taxable, and what happens if you report it as income and then subsequently repay it back to the plan or IRA. And then the third topic, we're just going to go over once again the loan provisions, and to just remind everybody in the last section is that the required minimum distributions are waived for all participants except those in defined benefit plans. So some of our clients, we may have a DB with a 401k wrap, so we need to make sure that the RMDs are taken. So let's just go through a brief overview of what the difference between a CRD and the participant loan relief that is afforded to us under the CARES Act. So the commonality of it is both are/were available to qualified individuals only, which we'll go through what defines a qualified individual and who gets to define that. And then the deadlines and or/opportunity periods. So the CRDs are available up until December 30th of this year, and that's not a typo, it is December 30th. The participant loan relief had a provision with increased loan limits of up to $100,000. That expired on September 23rd of 2020, so that's no longer available. However, for qualified individuals, if they have any repayments that are coming due from March 27th to the end of this year, they can suspend those or delay those repayments. And that is for a whole other topic of how it's reamortized when it starts back up. So we're just going to really concentrate on the CRDs for today. So what is a coronavirus-related distribution, or CRD? So basically, it is a disbursement to a qualified individual up to the lesser of 100% of the account balance, or $100,000. And this limit is a per person aggregate limit, per person combining all plans, whether that's an IRA or a 401k or the like. So it's $100,000 per person. And as I said before, this is not to be confused with the $100,000 increased loan limit, which expired on September 23rd of 2020. So with regard to the CRDs, we have up until the end of this year to take them. And if there are some loans that were deemed distribution during this period from the CARES Act through December 30th, that cannot be reclassified as a CRD. So any deemed distributions of loans, income tax would be due on the outstanding balance of the loan, and tax would need to be paid during this year. And if they are under 59.5, a 10% penalty would apply. So those are deemed distributions of loans, not to be confused with the CRDs. So the features of a CRD, what's so beneficial about it? Well, first and foremost is if you're under 59.5, it is exempt from the premature distribution penalty for those under age 59.5. With regard to the amount that you must include in income, it can either be included in income all in 2020 or ratably over 3 years. The participant also has the ability to recontribute within 3 years from the date of receipt of the CRD back to the plan or IRA. And if several distributions were made in 2020, so let's say the participant took 50 and now they want to take another 75, can you treat them differently? One all in 2020 and then the other ratably? No, you need to combine all of the CRDs in 1 year and apply the same taxability to them. With regard, the amount recontributed cannot exceed the amount of the CRD. So that means you can't gross it up for earnings or interest or things along those lines. With regard to withholding, another advantage is a regular distribution from a retirement plan is subject to a 20% mandatory withholding. With regard to a CRD, there's a 10% voluntary withholding, which the participant, if they sign a IRS Form W-4P, they can opt out of the 10% withholding, so they'll get all of their money to use now, which is when they really, really need it. So an interesting fact, who determines whether it's a CRD or not, or is it the plan, is it the participant? Basically, the participant or the individual is the one that's going to certify that they're a qualified individual and if it's a CRD or not. So fortunately, it's not up to the plan sponsor to decide or even to obtain, that information from the participant. They kind of totally wash their hands clean of that. So with regard to where can you take a CRD from? What is what the IRS calls an eligible retirement plan under the CARES Act? So for CRDs, it would be an individual account plan, so a defined contribution plan, or DC plan for short, which would be your profit sharing, your 401k, 403b, and 457b plans, IRAs, and also, if the defined benefit plan allows, after attainment of age 59 and a half, they could allow for coronavirus-related distributions. So who's a qualified individual? How do we determine who has the ability to take this money? First of all, receive the distribution from the plan. Most times there are only distributable events where we can get money from the plan, so this would create a distributable event where money goes out of the trust and it doesn't disqualify the plan. So with regard to determining whether a person is a qualified individual or not, it's self-certification by the participant, and that's what's accepted for verification by the plan sponsor, and that's all they need. So there's basically a 2-page, we have them in our firm, it's about a 2-page certification. So if anybody would like a copy of that, please feel free to email me, or if you have clients that would like to take advantage of this, I'm happy to share that. So basically, either the individual, their spouse, or the dependent has COVID-19, that's pretty straightforward, right? Or the individual spouse, member of the household, experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, and this rule basically applies to hours only. And there was another definition, which is the last one that was added in 2020-50, which allows if you have a reduction in pay. So for the second one, so if you're being quarantined, furloughed, laid off, having your work hours reduced, or a business owned or operated has closed, so basically the hours shut down. And then, as was added in Notice 2020-50, the individual experiences a reduction in pay or even self-employed income. So that's nice that they recognize the self-employed individuals. Or if they've had a job offer rescinded or start date for a job delayed due to COVID-19. So any one of these individuals is a qualified individual. I mean, it's a pretty big hoop to jump through. So I don't think that there's many people that haven't been affected by COVID and, by COVID-19 with regard to that. So now another question that comes up, what happens if you have a Roth IRA? Can you take a CRD from a Roth IRA? Well, the answer to that is yes. However, the rules, you may or may not have to pay tax on the income that is in that Roth account or that you're receiving as a distribution. So normally for Roths, you put the money in, if you leave it there till you're 59 and a half, it's in there for more than 5 years. Once you take it out, the earnings on that account are not taxable to you. However, if you take the money before one of those distributable events for a Roth, then you would pay income tax on the earnings portion of the distribution. So what the CARES Act does, unfortunately, it allows then a participant the ability to access those funds. They do not have any type, at this point in time, any provision where the earnings on it would not be taxable. So the earnings would be taxable. However, they're allowing the individual or participant the ability to have the favorable tax treatment on that. So that would be ratable taxation or in 2020 or repaying it or the like. So there's a little bit of a relief, but not as much as we'd hoped for. So how is a CRD reported by the payer? It's reported just as a regular pension distribution on IRS Form 1099-R. If currently right now the rules are sharing with us that we're going to use the code 2, this type of reporting, that they, as far as I know at this point, they don't have a special code for a CRD in that, which would make sense because it's really up to the participant to determine whether it's a CRD or not. That would just add burdensome reporting on the sponsor for sure. So this reporting is required even if they recontribute the distribution to the same plan in the same year. So let's say, for example, somebody took $50,000 in June of 2020 and now they put it back now. A 1099-R would still also be required of whether they put it back or not. So now, going down the line, so now how is this reported on the tax return for a qualified individual? So for a person that's had a CRD with the tax return, a Form 8915E is going to be used to say whether you're going to use the 3-year ratable or it's going to be all reported in 2020, and also to report any recontributions made during the year for this. Right now the form is out. It is in draft form right now, but it's probably going to look very, very similar to what it looks like now. We anticipate. So if multiple distributions are taken, as discussed before, so let's say 50,000 and then 25,000, and they take 75,000, all must be treated the same way tax-wise. So claim all as income in 2020 or ratably over 3 years, 25, 25, and 25. The individual also has the ability to repay these or recontribute these amounts back within 3 years of the date of receipt of the CRD. So there is that ability and some opportunity for tax planning, I would imagine. So as I stated before, it's still in draft form, and even if the participant recontributes the money, it's still you still have to do the 8915. So in that first scenario, somebody takes 50,000, they put it back. 1099-R reporting is required, and also the 8915E would be also required, showing the recontribution. So now with regard to the taxation for a CRD, right? So as shared before on an 8915E, it's either reported as income for 2020. So assuming they take a CRD for 2020 and they don't put it back to an eligible retirement plan before timely filing of the tax return of 2020, including extension. So you have up until the due date of the tax return, 2020 tax return, to put this back. So they would opt out of the 3-year rule on the 8915E, and it's all taxable in 2020. Or they're going to take the 3-year ratable, and 1/3 of the CRD is in gross income for 2020, 2021, and 2022. And under both options above, they still have up to 3 years from the date of the distribution to recontribute. And with regard to the tax returns, amended returns may be required depending on the circumstances. So here are a couple of examples that we'll go through. So this one's pretty straightforward. So participant takes the CRD in 2020 and repays it prior to the filing of their 2020 personal tax return. So here we have taxpayer A, qualified individual, need to be a qualified individual, received a $45,000 CRD on November 1st of 2020, receives no other CRDs in 2020, right, which are now available to the end of the year. So let's say end of March 31st, the taxpayer A recontributes $45,000 back to an IRA. And then on April 10th, they file their 2020 tax return. So in this case, Taxpayer A is going to get a 1099, and they're also going to do an 8915E, and they're going to elect out of the 3-year ratable. The default option is the 3-year ratable, so you need to actually opt out of that on the form. So example 2. So let's say the participant claims the CRD in 2020, and they repay it after filing their 2020 personal tax returns. How do we handle something like that? So same facts. Taxpayer A receives $45,000 on November 1st and no other CRDs. They file their 2020 tax return on April 10th, and they elect out of the 3-year rule on 8915E, which means they're going to claim the full $45,000 on their 2020 tax return. 20 days later, the taxpayer recontributes $45,000 to the IRA. Well, in that case, taxpayer A would file an amended return for 2020 and report the recontribution on Form 8915E. So basically, the CRD is included as income for 2020, and then the amended return would recoup the 2020 taxes paid on the CRD. So example number 3 is the participant wants to spread the tax ratably over 3 years and doesn't repay it. So this is also pretty straightforward. So they receive taxpayer B, a qualified individual, receives a $75,000 CRD November 1st, no other CRDs. And then taxpayer B files the 2020 tax return on April 10th of 2021, and they do not elect to opt out of the 3-year. So that means they're saying that they want to have this be taxed ratably, right? And there's no recontribution. So for taxpayer B, pretty simple, 75,000 divided by 3, 25,000 taxable in 2020, 25,000 2021, and 25,000 2022. So now here, let's say, for example, the taxpayer also wants to do the ratably over 3 years, and then they repay it. We're going to go through a few different scenarios on here of when they recontribute the money. So we're assuming they accept the default 3-year election, and they subsequently recontribute the CRD within 3 years. So scenario 1 of this example 4, the individual recontributes less than the amount that's ratably taxable in that respective year, and that's pretty straightforward. Scenario number 2, the individual recontributes exactly the same amount that's ratably taxable in that respective year. Also, once again, pretty straightforward. And then scenario 3, what happens if the individual recontributes more than the amount that's ratably taxable in that year? What do we do with that excess? How do we treat that tax-wise? And we'll go through those scenarios as well. So basically, this is where they're utilizing the 3-year rule, and they recontribute less than the amount that's ratably taxable in that year. So once again, we have taxpayer E this time, receives a CRD of $90,000 in 2020. They elect the 3-year with the 2020 tax return, so $30,000, $30,000, $30,000 per year. And then taxpayer E recontributes $10,000 in 2021. So the result for that is for 2020, $30,000 is taxable. For 2021, $20,000 is taxable, which is the 30 less the 10 recontribution. And in 2022, $30,000. Once again, that's pretty straightforward. So here's another pretty straightforward. So same situation there, but this time they're going to recontribute an amount equal to the amount ratably taxable. So same facts, 3-year. The tax result is in 2020, it's $30,000. 2021, it's $30,000 less the $30,000 they put in that year. And taxable in 2022 is $30,000 as well. Right. So now scenario 3 is a little bit different, and there's 2 options available, or 2 solutions. So let's say, once again, so what's going to happen, the individual is going to recontribute more than the amount that's ratably taxable in that year. And it's what do we do with that excess, right? So same facts, taxpayer E receives a CRD of $90,000, elects the 3 years, so it's taxable $30,000 in year 1, $30,000 2, and $30,000 in year 3. And in 2021, they're going to recontribute $45,000. So for 2020, $30,000 is taxable. For 2021, 30,000 would have been taxable, except for they put in 45,000, so we have a $15,000 excess. Well, what do we do with this excess? And with regard to this, there's two options available. So, option one is that the participant can take that excess and push it into the following year, into 2022. Or option two, an amended return can be filed for 2020, reflecting the excess from 2021, pushing it back into 2020, and then in 2022 it's $30,000. So also, pretty straightforward, but there are some options available to the taxpayer, and perhaps some tax planning. So for now, I would say that's pretty much it for the CRDs. If you have any clients or participants that you feel this might be helpful for, we have it until December 30th of this year. We most certainly can provide the forms necessary, so please feel free to reach out. So I just wanted to go through briefly the loan relief under the CARES Act. So the loan relief under the CARES Act had two provisions. One was the ability to take more than 50% of your account balance, up to 100%, or $100,000, the lesser of. So that increased loan limit was expired on September 23rd of 2020. However, the other loan relief was the ability for the participants to suspend payments until 1/1/2021. So, that's coming up on us now. So, if you have had any participants that has happened with, it's important to address it sooner rather than later, because payments will need to begin in January, and how they're handled depends on the specific circumstances. So, I have a quick example here. So let's say, for example, on April, a non-qualified participant had a non-forfeitable account balance of $40,000, right? They borrowed $20,000, 50%, and they began making repayments of $368 over 5 years. So the loan was taken on March 31st of 2020. It's due 5 years, March 31st, 2025. So the participant makes payments for 3 months through June, and then COVID hits and becomes a qualified individual, of which they self-certify to the employer. So repayments from July 1st, 2020 through December 31st, 2020 are suspended for this individual. What happens in this case, so the payments are going to resume 1/1/21, and the payments are 343.27, and just the general theory of how we get there. So you take the 1/1/21 balance with accrued interest is $19,477, right? Which is the balance when they stopped payments up until 1/1/21 at the interest rate that is stated in the promissory note. And then the loan, that $19,477, is reamortized from 1/1/21 when the payments begin to the new maturity date, which is 3/31/26, which is 12 months past the original maturity date. So that loan relief is still available, and that's still active. So I would suggest, in order to avoid default, if you have any of these situations, please reach out to our office so that we can walk you through it and have the participant avoid default on the loan. So thank you so much for your time. At this time, we're past Thanksgiving and the holidays are coming up in the new abnormal. So we're just wishing you and your families much health, healing, prosperity, all good stuff over the holidays and in the next year of the new normal. And as always, please feel free to call me, send me an email. I'm happy to answer any questions you may have. Thanks so much for your time. Be well.